Bismillahirrahmanirrahim. Assalamualaikum and good afternoon. So today I would like to discuss on a case study regarding JP Morgan. So as introduction, JP Morgan Chase & Co. was formed in 2000 when JP Morgan and Chase Manhattan, JP Morgan merges with Chase Manhattan Corporation. So JP Morgan Chase & Co. were listed in New York Stock Exchange, and they are basically mainly involved in commercial and investment banking all over the world. In 2011, their assets are valued over $2 trillion, and they are the largest hedge fund in the US. So as one of the big four banks in the US, JP Morgan has a strong and stable position in the market. They are the market leader in risk management area, and they are the pioneer of the famous value at risk method in risk assessments. However, in 2012, JP Morgan experienced a catastrophic loss of over $2 billion, where they incurred losses from complex trades transaction related to credit default swaps or CDS. So obviously this huge loss could not be attributed to only one or single factors, but rather they are a sequence of events or factors that accumulate to these losses. Huge loss of $2 billion in trading, but these are relatively small in comparison to their 25 billion pre-tax profits during the year 2012. So what actually went wrong during the trade? So I will go in details a few factors to explain what went wrong in JP Morgan at that time. So first of all, the first factor that contributed to this loss was the absence of risk and reward analysis. It is a standard practice among the banks or financial institutions that risk and reward analysis are being presented as the investment strategy before any strategy being implemented. So this risk and reward analysis should have been scrutinized over various levels in the board. For example, at the risk committee levels, and the senior management and the board level before it gets the approval. So this process should have been done in full transparency manner, so that it can be assessed independently by everybody. So in the absence of such analysis, the board as well as the risk management committee unit at JP Morgan were kept in the dark of the huge risk involved in the speculative transaction made, in specific related to the credit default swaps. Secondly, the failure of the management to detect earlier the risk associated with these speculative transactions. The senior management in JP Morgan failed to detect the risk related to the transaction in the Chief Investment Office or CIO. So this means that there is no proper monitoring systems in place which could have rang the alarm bell and triggered management to take immediate corrective measures. For example, to cut loss. You know, when they have entered into trades and the trades are against their positions or their favors, so a system should have triggered the management to cut loss. So if the cut loss was done, the actual loss incurred by the JP Morgan could have been minimized. Thirdly, we see an absence of corporate oversights. We see that in the Chief Investment Office, the traders are allowed to engage in highly speculative and risky derivatives, which were beyond the traditional CIO approach for safe and low risk investment. So these facts raise question whether the strategy was given a thorough scrutiny and supervision by the senior management. Some questions that we should ask ourselves are: how frequent did the risk committee meet to evaluate and trade the trading position and investment strategy? Did the CIO traders provide full disclosures of their trading positions to the risk committee? Is there any daily reporting provided to the senior management on the huge position taken in the credit default swaps? And also, we know that the CEO, James Simons, known for micromanaging the risk committee minutes, the risk committee meetings. So this raised further question whether the CEO interfere or overrule the risk committee decisions. Moving on, we see the problem also arise due to inexperienced and unqualified personnel in the chief investment office in JP Morgan. So this raised question whether JP Morgan, as a huge investment bank, did they hire competent risk management managers in the unit, because the unit itself oversees over 300 billion funds for the bank. So by right, they should have a systematic risk management system in place. There is a possibility that the chief risk officer or CRO did not have the necessary experience to adequately address the risk positions related to credit default swaps and speculative tradings. So with having CRO without the necessary experience may result in the system not having a proper risk measures in place. They could not have the chief risk officer could not understand the complexities of the trades, hence failed to put a comprehensive risk and governance framework behind the speculative transactions. So without this risk framework, it will be a great challenge for the risk unit to systematically monitor the trades activities done by the CIO traders. And there could also be that the risk team in CIO could be understaffed and inexperienced to oversee the whole transactions. The next factors that could also attribute to the loss incurred in JP Morgan was due to the change in the variance at risk model. So the management back in 2012, they changed the VAR model. There's a possibility that the CDS portfolio already breached the limits of previous VAR model. Therefore, the management decided to implement a new VAR model with a revised risk limit setting. So the VAR sets the risk limit on investment strategy or trades, which is a very subjective matter. It depends on the management whether they are going to be a risk averse or risk takers. And because these VAR are set by the management or as humans, so it is very subjective. So there's risk question whether a proper test or benchmarking process was done before the VAR is set. Now that we know the factors contributing to the trade loss in JP Morgan, I would like to share a few corrective measures that perhaps could avoid the same mistake happen in the future. First one is related to risk and governance framework. So JP Morgan firstly should ensure it has a comprehensive risk and governance policy as a framework for all its trading activities. The policy must be reviewed by an independent body and approved by the highest authority in the bank. So with this framework, all execution must be done according to framework. So there could be no loopholes in the system. Secondly, the bank should look into hiring qualified and independent risk managers. They should invest in risk management talents to ensure there is no loopholes in the system that can be manipulated by traders. Risk managers are often deemed as a second-class employees, as they do not generate or bring in money to corporations in comparison to sales units. But their expertise is equally important, if not more, to measure and monitor risks associated to business units or transactions. And this is very important as they could prevent a company from potential losses. And the risk management unit must also be independent from the investment unit so that they could function and perform their duties independently without any fear or prejudice. And thirdly, the JP Morgan could enhance their reporting and control. they should implement a comprehensive reporting and control associated with the total risk positions. The Chief Investment Office should present daily reporting on trading position to the risk committee as well as the management. A system must be in place that could immediately trigger the management to cut loss their position if the trades position are beyond the risk limit. And finally, there must be a stringent control in terms of federal regulatory. The government must play a role to enhance the financial regulation, especially the Dodd-Frank Act reforms, including a strong Volcker rule, which will curb trading by deposit-taking banks. The reform must be such that it will not tie the bank's hand completely to function in the market, while at the same time do not give them the absolute freedom to manage depositors' fund. So that's all from me. I end the slide here. Thank you very much.